Hey Kyra, this is Ryan with TrendLizard.com. Thanks for sending me an email on EWC, the Canadian iShares. There are a ton of charts I want to look at. There's a lot of interesting angles to consider with EWC. So let's take a look, starting long term and going in from there. So here is the really long term outlook from the inception back in 1996. It's hard to say exactly where it is in its super long term uptrend, but it's clear that it is in an uptrend. Every up leg that we're looking at here looks like a trendy move. Every pullback looks like a counter trend move. So that's a good sign. Clearly something changed in 2007. Really big pullback. The whole market pulled back pretty much anywhere you look. There's that huge pullback 2007 to 2009. Since then, EWC has lagged most other global markets and the U.S. as well. Hasn't really been able to get back above that 2007 high. You can see it's tested it twice. Was able to move a little bit above back in 2014. Since then, it's pulled back. So pretty interesting, especially trying to figure out exactly what's going on with this pullback here. So the big question is, did the overall uptrend resume off the 2009 low, or are we still in a massive counter trend pullback off that 2007 high? So my initial thought is that the uptrend has resumed. That seems to be that syncs up better with other markets, and normally these markets move somewhat together, even if they're not perfect correlations. They tend to generally move somewhat together. So this is what it would look like if the uptrend did resume off the 2009 low. Basically, we had a trendy up move into the 2011 high. Since then, there's been a big counter trend pullback. It actually moved very briefly below support, but since then, it's really snapped back strong, so it suggests that this support actually did serve its purpose, and it snapped back strong from there. So this is what I think is going on. This is the hope. The concern would be that something more bearish is going on, that this big pullback that began in 2007 is not yet over. So that would point back down to this low back in 2009 is kind of where it would head back from here if that's the case. So this is the bearish kind of worst case scenario. I don't think it's happening. I think this is more likely happening, but we can kind of play it out from here and see what that looks like as far as trading it under either scenario. So let's zoom in a little bit. This zooms in on the advance off the 2009 low. Not the greatest looking move, but this does look trendy. Excuse me, phone ringing in the background here. So this does look like a trendy move off the 2009 low into the 2011 high. Since then, there's no doubt this looks like one big counter trend pullback here. And again, it did find support kind of where it should have. Sorry again, phone's ringing. Anyway, found support where more or less where it should, and since then it's really come screaming back off the 2016 low. So this is what I think is going on once again, but there's ways that we can kind of determine if this is going on or not. So if we zoom in even further, this is looking at the recovery off of the 2016 low. So far it looks really strong. It's gained about 5.5 points in just a couple months, so that's really bullish. It looks like it has the potential to be trendy. It's not yet a trendy move, but it definitely has the potential to be trendy. So here's what you need to be watching here. EWC needs to stay above 21. If it trades below 21, it's going to look really bearish. It's going to bring back the possibility that the entire decline off the 2007 high is not yet complete. So really bearish stuff if it goes below 21. All bets are off if that happens, so be careful if that does happen. As long as it stays above 21, you should be bullish here. And if it trades above 27, that's going to be a really bullish sign. It's going to indicate that this labeling here is definitely not playing out. That would confirm that the uptrend has in fact resumed. So 27 is bullish. I don't think you would want to wait that long to buy it necessarily, but that's just a level to keep on your radar so that you know when it does get above there, you know that the risk of a larger counter trend pullback has gone away. So 21 is the level to watch to the downside. That's more proximate, something that you can use. I think you have to expect it to continue going up from here, and use 21 as a stop level and just trail it from there. And again, if 21's broken, all bets are off. It's going to look pretty bearish. So I hope that's helpful, Kira. And I will look forward to your tickers in the future. Have a great night, and we'll talk to you soon. Take care.